If you are age 50 or older and you are covered by a 401k or 403b plan, you may have questions about the optional catch-up contributions that are now available to you. I'm Michael Ruger. I'm the managing partner of Greenbush Financial Group. We handle hundreds of millions of dollars in 401k plans. We do lots of employee education meetings. And what we did is we accumulated the top questions asked by plan participants about catch-up contributions. The first question is, in general, how do these catch-up contributions work to these retirement accounts? So as soon as you've turned age 50, that makes you eligible for this slightly higher employee contribution. So in 2025, the regular contribution limit is $23,500. If the year you turn age 50, you're able to contribute an extra $7,500. So instead of just being limited to $23,500, you can contribute $31,000 in that year. The second question we receive is that catch-up contribution prorated in that first year you turn age 50, depending on what month your date of birth is? So let's say you turn age 50 on July 1st, so halfway through the year. Are you only eligible to contribute half of that catch-up amount? Or are you allowed to contribute the full $7,500? The answer is you contribute the full $7,500 in the year that you turn age 50. It doesn't matter if you turn age 50 on December 31st. If you turn 50 in that year, it makes you eligible for the full catch-up contribution amount. Question number 3, do you have the choice to make your catch-up contribution either pre-tax or Roth? As of 2025, the answer to that question is as long as your plan allows Roth contributions, you do have the option to either do that catch-up contribution in pre-tax dollars or Roth dollars, or some combination of the two. It's your choice. Those rules are potentially about to change in 2026, which we're going to address later on in this video. The next question we frequently receive is, how are these catch-up contributions going to impact my RMDs, or requirement of distributions, in the future when I turn age 73 or 75? And the answer is, it depends on whether you're doing your catch-up contributions in pre-tax dollars or Roth dollars, because pre-tax retirement accounts or sources are the ones that are subject to the RMD requirement that says when you turn, let's say, age 75, you have to take a certain amount out every year and pay tax at it. The Roth source in these plans are typically not subject to RMDs, so it really doesn't affect your RMD amount in the future. For individuals that still have mortgages against their house leading up to retirement, we will frequently get the question, Mike, is it better to apply my extra cash towards the mortgage to get that paid off prior to retirement, or should I put more money into my 401k via these catch-up contributions? And the answer is, it depends. It depends on a few items. It depends on the interest rate on your mortgage. It depends on what your current tax bracket is now versus what you're going to be in retirement. And it's also a question of what your debt preference is. Since there's 3 items in the mix, I'll address them one at a time. So the first being the interest rate question. Typically, if the interest rate on the mortgage is 4% or below, a lot of times that'll encourage someone to say, hey, the interest rate on your mortgage is so low, why don't you capture the tax benefit of making additional contributions to your retirement account? And I would hope that over the long term, you're earning higher than a 4% rate of return within your retirement account, which justifies putting more in the retirement account versus paying down the mortgage faster. The second variable being tax bracket. If I have someone who's in a very high tax bracket leading up to retirement, which is not uncommon, because a lot of times people are in their peak income earning years right before they retire, it might be more advantageous to take that income off the table via pre-tax catch-up contribution to the 401k, essentially pushing that money in the retirement years when it's taxed at a lower rate, as opposed to using their extra money to pay down a relatively low interest rate mortgage. The third one is debt preference, which is probably the most important, because you might say, hey, I've got a really low interest rate mortgage, I'm in a really high tax bracket, but if at the end of it they say, I just don't really like debt, and I don't like the idea of having a mortgage and added expenses going to the retirement years, that sometimes can trump the other 2 items. Because if you just have a preference that you would prefer to be more debt-free in retirement, then it can justify using your excess cash to pay off the mortgage prior to retirement versus using that money to put more into a 401k plan. Next question. Sometimes plan participants, let's say they're age 54 and they're just finding out about these catch-up contributions now. And they'll ask, hey, Mike, I've missed out on the last 3 years. can I go back and make up those missed catch-up contributions now since I'm kind of behind on retirement savings? And unfortunately, the answer to this one is no, you can't go back. If you've missed the opportunity to make those, let's say $7,000 or $7,500 contributions in catch-up in previous years, that opportunity is now lost. You still are able to contribute for the current calendar year, but there's no way to go back. For employees that reduce their work hours from full-time to part-time, they'll sometimes ask us, Mike, can I still contribute to the 401k even though I've reduced my hours? And the answer is, as long as you are eligible to contribute to the 401k when you're a full-time employee, when you reduce your hours, you should still be able to contribute your employee deferrals to the plan, the same limits. But you have to be aware that really the limits in the 401k for employee deferrals are the lesser of 100% of your compensation or the annual deferral limits, which for someone a normal age 50 or older would be $31,000. So if someone only made $20,000 for the year in W-2, the most they can put into the plan is $20,000 because again, it's a lesser of what you actually made in W-2 or the annual contribution limit. The most popular question of 2025 is, Mike, what is this new age 60 to 63 catch-up contribution that just started this year? So catch-up used to be simple. Once you're over 50, you're eligible for the special catch-up amount and nothing changed. But with the Secure Act 2.0, it made a ton of changes to 401ks, and it made so many changes that they're actually implementing the changes in phases. And one of the changes that got phased in 2025 is this new special enhanced catch-up that if you turn age 60 to 63 in 2025, you're not eligible for just the $7,500. You're actually eligible for an enhanced catch-up, which is equal to 150% of the regular catch-up amount. So the regular catch-up amount is $7,500. If you're somewhere between age 60 and 63, your catch-up amount is $11,250. Because that's a little confusing, let me just give you an example. So if you're anywhere between age 50 and 59, you're able to do the regular employee contribution amount and the $7,500 catch-up. When you turn 60 to 63, you're able to do the regular contribution amount plus the enhanced catch-up, which is $11,250. And then in the year you turn 64, you actually go back to the regular contribution amount of $7,500. The next big change that's happening for catch-up contributions, if there weren't enough changes already, are the changes that are going to be happening in 2026, which is going to require high income earners that are making catch-up contributions to do them all Roth. So high income earners starting in 2026 may not even have the option anymore of doing their catch-up contributions pre-tax, which might be a major tax disadvantage because, again, a lot of times people in their peak income earning years and they want to get as much income off the table as possible via pre-tax contributions. That might not be an option 2026 and years going forward. The way this is going to work is in 2026, any employee that made more than $145,000 in wages in the previous calendar year, in that plan year, they will be required to do their catch-up contribution in Roth. They will not have the option any longer to do a pre-tax. Now, any employee that was below that $145,000 in wages, they can continue to select between pre-tax or Roth. This is only going to impact what's considered the high income earning employees 2026 and years going forward. I hope this information was helpful. If you have any other questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.